The decision Japan makes on the 8th of February could quietly change the direction of the U.S. stock market. What happens when a decision that looks domestic is powerful enough to shake the U.S. dollar, push inflation higher, and redirect American markets? What happens when the country holding the largest amount of U.S. dollar assets in the world is forced to change its money policy? The 8th of February 2026 is the moment when those answers begin to surface. For investors who understand how global capital moves, missing this moment could mean missing a major turning point. On that day, Japan will make a critical decision about printing money. This is not only a story about Japan, it is a story about the U.S. dollar. And the U.S. stock market, Japan is not a small player. It is the largest foreign holder of U.S. dollar assets. Every move it makes sends signals through global markets. The problem is that Japan's economy has been under serious strain. If domestic pressure forces Japan to sell a large amount of U.S. dollars, the value of the dollar could weaken, U.S. inflation could rise, and pressure would land directly on the American economy. To understand why the 8th of February matters, we need to understand how Japan arrived here. For decades, Japan did not fight inflation. It lived with deflation. Deflation means prices fall over time. The opposite of inflation, where prices rise as money loses value. For consumers, deflation sounds appealing. The same money buys more over time. But for governments and economies, deflation is dangerous. Asset prices fall, spending slows, growth weakens, people delay major purchases, expecting things to be cheaper later. That cycle can trap an economy for years. To escape it, the Japanese government spent decades trying to stimulate growth. They printed money, they pushed interest rates lower and lower, and low did not mean 1%. It did not even mean 0%. Japan went further into negative interest rates. Negative interest rates defy intuition. With positive rates, a borrower repays more than they borrowed. With negative rates, a borrower can repay less. The lender accepts a loss. This happened for two reasons. First, when every option loses money, investors choose the least damaging one. Second, and more importantly, the largest lender to the Japanese government is the Bank of Japan. Its central bank, as a central bank, it can accept losses to keep the economy functioning. For years, this policy was justified as a fight against deflation, but consequences eventually arrive. After years of money printing and negative rates, Japan now faces inflation, not deflation. That shift changes everything. Now, the Japanese government stands at a crossroads. The prime minister and the government want to print more money, but to do so, they need approval on the 8th of February. Without that approval, their plans are constrained. Either outcome will change Japan's interest rate path. And when that path changes, global markets feel it immediately, especially the United States. One reason is the yen carry trade. For years, Japan has had the lowest interest rates among developed nations. Money could be borrowed at almost no cost. Global banks, institutions, and investors use that opportunity. They borrowed Japanese yen cheaply and invested the money in the United States. Stocks, real estate, digital assets, anything with higher returns. When you borrow near zero and earn 5 to 6% elsewhere, the difference drives the flow of capital. That gap is what fuels markets. And that is why any change in Japan's policy can quietly shake the foundation of the U.S. market, often before most investors realize what has changed. That flow of capital over many years became a massive source of buying power, supporting United States asset markets. It stretched across the years 2024, 2023, 2022, And even further back, when markets are viewed through a long-term lens, it becomes clear that much of the upward momentum came not only from internal growth, but from a steady inflow of cheap money. Because of that, the concern here is simple, yet far from insignificant. If Japan begins to raise interest rates and gradually pulls back economic stimulus, the interest rate carry trade will narrow. When that happens, less cheap money flows into United States asset markets. Less money means less buying pressure. And when buying pressure weakens, the United States stock market will eventually feel the strain. For serious investors, what matters is not reacting to eye-catching headlines. What matters is understanding the mechanics beneath the surface. Markets reward those with method, discipline, and the ability to look beyond short-term noise. The real objective is not to follow the crowd, but to build durable investment thinking strong enough to recognize opportunity early and avoid common mistakes. When market psychology shifts, turning back to Japan, there is another reason the situation is so sensitive. It lies in the housing market and the structure of mortgage loans. In Japan, roughly 79% of home mortgages are floating rate loans. This is extremely high when compared to the United States, where the figure is below 10%. As interest rates rise, and Japan is now at its highest rate level in roughly 30 years, homeowners with floating rate loans immediately face higher monthly payments. If income cannot keep up with those higher payments, pressure spreads quickly through the financial system. That pressure leads to bad debt, then defaults, and eventually home foreclosures. History has already shown what this looks like. During the housing crisis in the United States in 2008, problems that began in real estate spread across the entire financial system. Those lessons remain relevant, especially when debt structures make economies more sensitive to interest rate movements. The third reason, and one many underestimate, is Japan's role in the global debt market. Japan is the largest foreign holder of United States dollars and United States Treasury bonds. Japan holds roughly $1.2 trillion of United States government debt. This is not accidental. For a Japanese investor, when the domestic government pays negative interest and the United States government pays positive interest, the natural choice is the option with higher return. Even a few percentage points are better than a guaranteed loss. But this balance can change. If Japan continues to raise rates and begins offering real positive yields closer to those on United States Treasury bonds, Japanese investors will see the world differently. Capital no longer needs to automatically flow overseas. Keeping money at home becomes a rational and cautious decision. That shift creates pressure inside the United States because Treasury yields are determined by supply and demand. When many lenders buy United States government debt, the United States does not need to offer high interest rates. But when fewer buyers appear, the United States must raise yields. To compete for capital, this matters far beyond bond traders. United States Treasury yields are the base interest rate of the entire economy. That base rate affects mortgage rates, it affects car loans, it affects credit cards, it affects business borrowing. In practical terms, it influences almost everything. So if Japan slows its purchases of United States Treasury bonds and yields rise because the United States must compete more aggressively for capital, borrowing becomes more expensive across the domestic economy. That is why this matters. The key point is this: we do not need to predict every detail of what happens next to understand the impact. The 8th of February is a decisive moment, and decisive moments always leave a mark on markets. Japan's path on money printing and interest rates will send waves through global liquidity. And global liquidity has always moved quickly into United States stock markets. Over the past 12 to 18 months, markets have repeatedly reacted to movements in Japanese bond markets, to expectations of economic stimulus, and to changes in interest rates looking even wider. Beneath all of this lies a larger issue. Japan carries a record level of debt relative to the size of its economy. Its debt to gross domestic product ratio is around 240%. This number shows how narrow policy flexibility has become. By comparison, the United States stands around 120 to 125%. This contrast makes one thing clear. Japan's room to maneuver is becoming more limited than ever. And in that environment, every monetary decision carries far more weight than it appears on the surface. In the United States, the story of national debt is repeated again and again, and with enormous figures such as $38 trillion that make many people uneasy and spark constant debate about the stability of the system. But when viewed calmly and over the long term in the way a legendary investor would, the situation in Japan invites even deeper reflection. Japan's level of debt has grown far beyond the size of its own economy, almost double by comparison. And yet within that context, the country is still considering a stronger expansion of money printing to sustain economic growth. This is a nation that spent decades fighting deflation and accepted policies once considered extreme, such as negative interest rates. Now it stands under inflationary pressure with an enormous debt burden and approaching a crucial policy moment. On the 8th day of February, a moment that could shape the direction of the years ahead. What draws global investors' attention is not only the decision itself, but the expectations about what will follow afterward. Japan's influence on the United States is not abstract. It rests on very concrete foundations. First, Japan is one of the largest holders of the United States dollars and United States Treasury bonds. So any shift in its financial behavior can ripple through major markets. Second, for many years, investors around the world borrowed the Japanese yen at extremely low cost and redirected that capital into United States stocks, digital assets, real estate, and other risk assets. That flow of money has not been a minor detail, but a powerful force behind market momentum. Third, Japan remains a major economy in a deeply globalized world, where a shock in one large financial system can quickly spread to many others. From this perspective, the key question is not distant macro theory, but what it truly means for each individual investor. It means that anyone in the market must understand the opportunities and the quiet transitions now unfolding within Japan. This is not only a matter of interest rates or stimulus packages, but a deeper transformation in how Japan seeks to manage its economy and how Japanese companies are being encouraged to operate with greater efficiency. For a very long time, Japan followed a system that prioritized stakeholders. Companies existed not solely for shareholders, but also for employees, customers, and long-standing relationships. That culture meant Japanese firms did not obsess over pushing share prices higher and cost. Instead, they emphasized stability, long-term employment, enduring relationships, and balance among interests. When this model is compared with the United States, the contrast becomes clear. In the United States, shareholders stand at the center. Chief executive officers carry a legal obligation to maximize shareholder value. Compensation structures, incentives, and definitions of success are largely built around stock performance. What matters now is that Japan is gradually moving away from its traditional model. The shift toward a more shareholder-focused approach, closer to the United States system, is creating new possibilities. When incentives and culture change, corporate behavior changes as well. Capital allocation becomes more disciplined, efficiency gains importance, and actions such as share buybacks and dividend payments receive greater attention from the viewpoint of a patient investor. This is often where opportunity emerges, not from dramatic headlines, but from slow structural change. Belief in this transition does not mean blind investing. There are many ways to access the Japanese market through diversified funds and exchange-traded funds without selecting individual companies. Yet risk is always present. No investment offers guaranteed returns, and periods of loss are inevitable. That reality is not an exception, but a natural part of the process. For that reason, independent judgment and careful personal evaluation remain essential. No one should place total trust in anonymous voices, but instead seek to understand how the economic system operates in order to make decisions suited to their own situation. Change is unavoidable, and not every change fits every person. In the end, there is a simple truth often overlooked. Over the long run, those who own assets and remain committed investors are typically the ones who benefit from the economic system. The system itself is designed to reward long-term participation. Unfortunately, many people are never taught this, yet history has shown repeatedly that those who stay engaged and understand the value of investing are the ones who gain as the economy grows. And the path toward that outcome ultimately begins with a very basic decision, choosing where to invest and having the patience to stay with that choice. It does not matter where you are starting on your financial journey. What truly matters is that you are willing to begin allocating assets across different areas, such as real estate, stocks, digital assets, and even early stage businesses is not about following trends. It is a practical way to protect yourself across asset cycles and economic cycles. Markets rise, markets fall, different assets move at different speeds, at different times. Because of that, instead of trying to predict the perfect moment in the market, it is wiser to build the ability to take control of the market through structure and long-term thinking. You do not need to know exactly what will happen tomorrow to build a strong long-term position. What you need is exposure, discipline, and a strategy that can survive across different environments. A strong strategy does not collapse when volatility appears. It remains steady and adapts as conditions change. For those who want to go deeper and clearly understand the framework used to study and select stocks, and to see how specific opportunities are identified and held, having access to a structured learning system becomes meaningful. Within such a system, market analysis is updated regularly. Investment decisions are explained clearly, and the process of building wealth is broken down into logical steps, from forming the right mindset to learning how to recognize opportunities before they become obvious. More importantly, it helps shape the way a top-level investor thinks. This is the mindset of someone who is not driven by short-term emotion, but focused on long-term value. If these insights help you better understand what is unfolding and why a specific policy moment, such as the 8th of February, can influence the United States dollar and the United States stock market, then sharing that understanding also carries real value. By continuing to follow and by sharing with friends, family, or other investors, you not only expand your own perspective, but also help others make clearer, more thoughtful decisions, because the more people who understand how the system truly works, the less they are controlled by fear or short-term excitement. And as understanding grows, the quality of financial decisions improves, not only for individuals, but for the broader investing community as well.